Vincent, great to have you on. And I am going to start with this recent report you put out. You say every important financial and economic matter will be affected by this war, meaning this invasion of Russia into Ukraine right now. How do you see this rippling out both in the near term and the long term?
Well, in the near term, I mean, all we can do is really hope for peace and a speedy resolution, but that fortunately doesn't seem to be the likely path. The more likely outcome is really a drawn-out conflict. I mean, Ukraine is a very large country, 40 million people. It's bigger than France. It's very hard to occupy. So this will disrupt, first and foremost, the lives of the Ukrainian people, but also this will disrupt the global economy. I mean, you look at any commodity. I mean, Russia is either the top or one of the top three producers. And you'll see the ripple effects, as you mentioned, from valuations in the U.S., which are very high and will suffer from this, to global agricultural prices and potentially geopolitical consequences, especially for North Africa, the Middle East, balance of payment crisis. So this will not go away rapidly, in my estimation.
So one of the things you've done is you've compiled data for something called the Military Misery Index, and it's through that data that your thesis operates that U.S. stock valuations could drop by 60%. Walk me through it.
Well, and I just want to make clear, this is not a price forecast. It's based on the SHILA, so cyclically adjusted price earnings ratio. So you take 10 years of inflation-adjusted earnings and then divide the price by this ratio. And it's a forecast that over time, this ratio could fall by up to 60%. Now, that doesn't mean that price falls by 60%, obviously. One thing that can happen is that the earnings part, the denominator, rises. And some of that will happen naturally, right? As we see the depressed earning from the Great Depression fall off that trailing 10-year window, the multiple is going to increase mechanically. So I just want to make clear that I don't expect the S&P 500 to grow by 60%. But this is indeed the experience that we had in the 70s. We had a very similar setup in the late 60s, where we had very high valuations. We had very low interest rates, and then we got into this era of high inflation, wars, primarily the Vietnam War, increased defense spending. And over the course of 15 years, you saw the cyclically adjusted valuation of U.S. stocks drop from about 30 to 10. Today we're at 35. So if we look at where we are in inflation, which around 8%, we have about 4% in defense spending. That model tells us we should be looking at about a 17 ratio. And then if, as I expect, inflation does increase, and we have to increase military spending as a result, we could go all the way down to 3.
Vincent, because you're running that model since 1960, in effect, all it really does is give you what happened in the 1970s when those conditions were mostly in place, correct? The inflation plus the military spending. You also had yields much higher than they are at current levels. Obviously, after 74, they were from 7 to 10% on 10-year yields, well up above that into the early 80s. So would you say that the bond market is that mispriced right now, or are we still operating in a mode where inflation still could be really just kind of a window in time that's going to be just a couple of years?
That is an excellent. But I would say, if I wanted to go with the analog of the 70s, we're probably late 60s right now. We're not in the 70s. I mean, we had a similar moment in the late 60s where inflation was picking up as the Vietnam War was building, the gold window was starting to empty itself, and the bond market's reaction at the time was disbelief, just as it is today. There was this view, oh, this is transitory. I mean, this is when we started stripping out oil from the PCI and focusing on core, saying, well, we're not going to raise interest rates because oil prices are up. I mean, everything that we're going through today, we went through in the 70s. So, again, it's a process that takes time. And we are in the early innings. And indeed, as you point out, the crucial behavior is going to be the behavior of the long end of the curve, because this is how equities are priced. I mean, equities are priced out of long-term rates. This is why so far most of the shock has been on the 2-year, right, going from 0 to 2. What you want to look at is that 10-year yield.